I'm here with Dominick D'Angelo, the Director of Research at O'Keefe Stevens. This past week, he went to a conference in Orlando, the ICR conference. Dom, do you mind sharing a little bit more about what that is?
Yeah, so the ICR conference, it's a 3-day event where you have public companies and private companies that are primarily in the retail and consumer space. You also have some real estate companies as well, but they all have a general theme of their end customer is the consumer. It's 3 days of presentations, meetings with management teams, group meetings. They have dinners, lunches, presentations that occur throughout the day. And then sometimes they'll have panels of industry experts that give their take on what they see occurring in the current environment. So overall, it's a fire hose of information that you're consuming, and all of the presentations are around 25 minutes. So you probably attended 15 different meetings or presentations a day, and then afterwards you get to hang out and talk with other investors to see what they found interesting, any ideas that they're working on, etc.
Get to hear from a bunch of different people, a bunch of different companies, and also meet a bunch of people as well. What were some of the general themes while you were there?
Yeah, I think the one that stood out the most is everybody seems to be gravitating towards this more healthier, uh, healthier consumer and food option. Um, Meaning, I don't remember a lot of presentations where somebody was pitching like a fried type of food. Like Shake Shack talked about trying to get some healthier options. Um, a lot of the breakfast companies, breakfast and brunch companies talked about maybe in the past you would go in order like a Denny's Grand Slam. You get your eggs, toast, bacon, sausage, and historically maybe that breakfast that they ordered is like not the most health conscious, but now you've got like the rise of avocado toast or maybe just egg white omelets versus traditional egg and yolk omelets. And I think it was just a interesting development because I think there were 3 or 4 different breakfast brunch companies there that all talked about having a lot of opportunity in this space. So one of the companies that presented was First Watch. They own about 600 restaurants. Primarily, they own all the restaurants. They do have some franchises. One of the things sometimes companies will do is they pre-announce results the day of the ICR conference, and then they'll go on stage and talk about what happened in the fourth quarter. And First Watch was one of them. In general, their results were fine. Traffic was down a little, but same store sales growth, which is the main metric everyone's going to be looking at, was relatively healthy. They play in the healthier, sort of more I don't want to say convenient, but their goal is to have, I believe, like relatively quick turnover at the table, maybe 45 minutes or less. Having a consumer come in, eat, that allows them to charge maybe slightly lower prices because if they can turn the tables a little faster, then you get more customers. And when you have a fixed, basically operating expense line with their real estate footprint, the more customers you can get in, the better. So I think health conscious, uh, breakfast, brunch, having a lot of white space. Denny's, I believe, just was taken private in this past year by private equity. My suspicion is like Denny's, IHOP, like all of your legacy sort of breakfast places are not what they were maybe 10, 20 years ago. And if those restaurants start to exit the space, does that present the white space for First Watch and other brands to grow into their markets?
Yeah, you're definitely seeing a rise with things with healthier eating, things like Chipotle, fitness.
Yep.
So that's definitely something to keep an eye on. How about another thing I saw is that you were able to speak to Planet Fitness. What were your thoughts there?
Yeah, so Planet Fitness, they primarily operate a franchise style, so they don't really own any of the locations that they operate. Um, it's interesting because Planet Fitness in the past was, if you've ever gone into one, it might have been 80% of the square footage was dedicated to some sort of cardio equipment, treadmill, elliptical, the rise of the Stairmaster now. They are understanding that the consumer is not just about cardio, that the rise of protein and just strength in general, how important that is to longevity and just like the health of a person. And so they are removing some of the cardio equipment and replacing it with more strength equipment. And I think that's probably a very smart move, just given at least what I see, at least at LA Fitness, where I go, and just like the overall trends of um, the fitness industry. They're growing fast. They took price, I believe, last year with their Black Card, increasing that, I think $5 or $10. They're starting to explore what European expansion looks like. They did a JV in Spain as like a proof of concept. That's gone well thus far. And then the other thing that was interesting was that they said 30% of people wear some sort of health device, whether that's a Fitbit, uh, a Whoop, an Apple Watch, things like that. So again, everything just appears to me, First Watch, Planet Fitness, people are starting to care more and more about what they eat, how they exercise, and just seems like a lot of people are getting more knowledge. And I think all of these wearable devices are certainly helping that cause.
Yeah, absolutely. I definitely see the rise of wearables, especially. Um, how about on the retail side? I know that there were some companies over there as well.
Yeah, so the one that I thought was the most interesting was Carter's. They make infant clothes, baby clothes. They have had a relatively tough, uh, tough go over the past, call it, couple of years, with sales declining, same store sales relatively weak. And so they sign 10-year leases. They're in malls, retail outlets. And so when you sign a 10-year lease, obviously you probably have a good idea what the store is going to do in like the first 5 years. Once you get beyond that, maybe there's a little more question on what the stabilized revenue figure is at different locations. And it appears that they opened some locations that maybe over time just deteriorated. So they identified 150 stores that they're going to close over the next 2 years. They did 30 last year. They plan on doing 70 in 2026 and then 50 in 2027. And those 150 stores generated about 110 million of revenue, and that is probably what they said is like it's marginally profitable for them. So even though revenue is going to decline somewhat, the profitability of the company is not. And if you actually look at the overall economics of Carter's and the business, closing those 10 stores will likely improve margins over the next couple of years. So I think the rationalization of their footprint is a good thing, and margins inflecting higher is also a good thing. They created a line called Simple Joy specifically for Amazon. It sounded like they're going to start moving away from that or getting out of that in favor of growing their core brands. Again, my suspicion is they're exiting that Amazon business because it's a lower margin business, probably not a good return on invested capital type business. So in 2026, they expect sales to grow and EBIT to grow, even though you've got some headwinds from the closing of stores. And when you get a company that's, if you look a couple years out, that should have rationalized their footprint, margins improving, likely the store economics improving, it then comes down to what's the receptiveness to their clothing brands, to moms, infants, things like that. And it's just a interesting story. I had not really done much research on the company prior to this, but this the story makes sense to me. The question is more just I don't know what, millennials um, view Carter's brand like. Do they like Carter's brand, don't like Carter's brand because they'll be the next ones to start families? And uh, if there's no attraction or if they find, other brands that are more appealing to them, then, you know, it's another leg to the story. But I think for now, just the story that they told makes sense to me. CEO has been there for 1 year. Usually turnarounds don't happen overnight. So just wanted to keep an eye on that. It was interesting.
That's an interesting point that it's almost delayed. Their current customers are generation or two older, so
Yep.
that's something I hadn't thought about. Some of our clients may remember investments in Kimco and Tanger outlets as well. I know that they were at the meeting as well. What were your thoughts on those presentations?
Yeah. So I saw their presentations and then also had one-on-one meetings with their management teams. Tanger was interesting. I told them, we sold your stock because we thought it got a little expensive, and just like walk them through the rationale behind it. They have an interesting story. So they operate the Tanger outlets, and uh, my main questions to them were, hey, you've got the rise of Burlington, TJ Maxx, Marshalls, and then e-commerce. Like, how do you guys view the outlet strategy in tandem with the rise of these alternatives that likely compete um, with you guys? And their goal is to not make the outlets necessarily just like a retail shopping experience. They're attracting other restaurants I'm going to say more events to make it more of like a destination of sorts where you go maybe eat dinner, also do some shopping. Maybe there's some sort of band playing as well. And so their way to compete with these other off-brand off-brand retailers is uh, can they find other reasons to drive traffic or drive other, I guess reasons to drive traffic to their stores. The thing that's tough with the outlets is outlets are supposed to be places where you go and you get a bargain. Like if I go to a Ralph Lauren at a Tanger outlets, I don't want to go there expecting to pay 10% off. I'm going there because I'm expecting, significant discounts based on what I would go pay at a Macy's or a J.C. Penney, wherever else their clothing is sold. And they disclose what their sales per square foot is, and it's challenging to discern what is good or bad for the outlets. Because if you think about a consumer wanting to go to an outlet because they get a good deal, that means the price of what these stores are selling their products for is at a discount or is cheaper. And so if you think about an outlet store that has flat traffic, but maybe now they're discounting more their inventory, well, the sales per square foot would then decline by whatever those discounts are. So on the surface, it looks like, oh, Tanger isn't doing as well because their sales per square foot is not as high as it was last year. Or is it a good thing because people go there expecting to get the bargain deals, and therefore the lower prices in the future should incentivize more shoppers to go to the outlets? And so um, had that conversation with the management team, and they agreed that sales per square foot looked at just through like what it is, what the number says, doesn't actually tell the full story of what it means going forward. I thought the interesting part that they said was they do some acquisitions, and they typically try and buy from mom and pops or just like one or two outlet owners. And they said that when they acquire a new center, that center has their own dedicated leasing team and other administrative personnel. They go in, basically take everything out and bring it in-house. And they said when they do that and they call up their existing relationships with Under Armour, Nike, whoever else they have, a lot of the time they'll call Nike and say, hey, we have this brand new outlet. You're not in it. What are your thoughts? Would you like to come? And Nike would be like, I didn't even know that outlet existed. So there's just a significant difference between the operations that Tanger has versus what smaller developers or owners have. And then finally, the thing that was also interesting was they used an example where Kate Spade may want to advertise that they have this new purse during the holidays, and Tanger will go to Kate Spade and say, "Hey, you can advertise at our 40 plus different outlets. It'll cost you X amount of dollars." Smaller operators don't have this massive portfolio to get some widespread marketing out there versus Tanger, that's all incremental profit that has almost no cost associated with it. And it's just like a different, source of revenue that they can derive from just their traditional leases.
Yeah, sounds like they're really thinking about some secondary sources of revenue with the
Absolutely.
events and the marketing as well.
Yeah.
Any other companies you want to hit on?
Um, Good question. The only other, you mentioned Kimco real quick. I'll just touch on Kimco because it's one we
Yeah.
sold as well last year. Um, we sold them similar reason. Valuation just got a little higher than what we were comfortable with, and it seemed like the market was pricing in interest rates coming down, and therefore the valuation today was predicated on lower rates, and thus lower rates would result in higher property valuations. Kimco is an interesting story. They're almost fully occupied on their grocery anchored centers. The two things that were very interesting, just in like the broader retail space, was there is no supply coming online, so no new construction is happening in retail, and that's allowing the likes of Kimco, Tanger to charge higher rents because there is like no alternative for these companies to go. So if you have no supply coming online and you're a retail company that wants to say, "Hey, I don't want to be in this Kimco location anymore. I want to go somewhere else," there's just not a lot of options for you. And then therefore that gives the landlords, the owners, the bargaining power. And I can't remember who said it, but one of them said that rents need to go up somewhere around I believe it's 40 to 50% to make the economics of a new construction of a retail center or maybe an outlet mall make sense. And so therefore we are like so far away from any new build coming online that Kimco, Tanger, other REITs are going to have some bargaining power in the future, consistent to probably what they are seeing today. So the story with Tanger or with Kimco is they've got 98, 99% of their grocery anchored large big box occupied. I think it's somewhere around 93, 94% of their smaller boxes are occupied. Uh, they're trying to monetize some of the out parcels that are at these different locations. Maybe they've got like a large parking lot that's basically bigger than what they need today, and can they put a Shake Shack or a Dunkin' Donuts somewhere in the out parcel, and that's just basically added revenue for that property without this large overhead cost. Um, so I think the REIT story specifically on the retail side is interesting. Uh, I think a lot of the stocks today are somewhat priced as the rents that they're charging today and the rate increases they're getting are going to happen into the future. The outlet mall business model, I'm still somewhat concerned. I'm not sure how relevant it's going to be in 10 years. And so Tanger, I don't think is one where we would consider purchasing it, at least at today's price. Um, Kimco's a good business, relatively recession resistant, given their business model is to own grocery anchored shopping centers. Groceries are basically recession resistant. So good business model. Basically just the price is not where we would want to buy it at.
Yeah, and nowadays it's never been more convenient to buy things with Amazon and online
Yeah.
shopping. To leave your home and go somewhere like that is
Yeah.
it's certainly tough to get people to do it. So makes sense why they're branching out into different things like that as well. Um, I know New Era was there as well. What were your thoughts about that presentation?
Yeah, New Era Hat Company out of Buffalo. That was probably the largest crowd I remember seeing for any presentation. And for a private company, interesting because basically everybody there was some sort of public investor, so they couldn't invest in New Era today. But um, if you read between the lines, and you don't even need to look too hard, New Era is probably going to be coming public in the not too distant future. They made an acquisition recently of 47 Brands, another hat brand, and my suspicion is that delayed the IPO that New Era probably had in the pipeline, so they could sort of just like integrate everything before they came public. Uh, Good company. It was fascinating to hear their origin story. They've been around for I don't know if it's 150 years, but they've been around for a very long time, and it was hilarious. The reason they got to where they are today is um, basically like somebody said, "Hey, why can't I buy the hats that the pro teams wear?" Back in the day, and this is in the 60s, 70s, where New Era would only make hats for professional teams. They wouldn't make it for any consumers. And so somebody asked, like, "Hey, why can't I buy these Philadelphia Eagles hats or whatever, whatever hat they wanted?" And New Era was basically like, I don't know if anybody is actually going to want these or not, but let's take an ad out in the newspaper. And in the ad, we'll say, hey, if you send us $10 to this address with the hat that you want and the address to where we should send it back, we will ship you a hat. And long story short, the guy goes into the post office one day and he goes to his whatever mailbox, pulls out all the mail, and maybe there's like a bag there that he takes with him. And he's walking out, and the post office person goes, "Hey, where are you going? We have thousands of pieces of mail for you in the back." And they get home, how they delivered however many hats, and looked at each other and were like, "Okay, I think we just found our new business model." And so ever since, I think that was like 1972, something around there. And ever since then, they've just been like the brand for sports and different types of hats. So it was I didn't growing up in Buffalo didn't know the backstory to it, so just thought it was fascinating.
That's a pretty cool story.
Yeah.
When you go to conferences like these, you have the unique and also valuable opportunity to hear from the leadership teams. Who are some of the people you're meeting with when you go to these types of conferences?
Yeah, besides the management teams, it's typically going to be other investors that I've either made connections with in the past or basically have listened. And I think the more of these you go to, the more you realize like everybody is there to either get ideas, talk about different ideas, and so like the openness that everybody has and the receptiveness to. I went up to a guy I subscribe to, and I was like, "Hey, I just want to introduce myself." And we ended up having a 20-minute conversation about different companies, and like people are just there to learn. And if as long as you're there to give uh, either ideas or different information than maybe they would otherwise have, like everybody's there to happy to talk to you.
That's cool. Any particular companies that you may be keeping your eye on coming out of the meeting?
Um, Talked about Carter's before. Patrick Industries is another one. They're in the RV space. Uh, the RV space post COVID has uh, seen a significant decline in basically just like the number of new purchases of RVs. Um, we potentially worked through just like that pull forward of demand. And Patrick I believe they're a manufacturing company. I don't know a significant amount about them, but they have like 30% capacity available should demand increase. So 70% capacity utilization, and anybody that has 30% excess capacity, that's an industrial company, manufacturer, those incremental revenue profits are very high margins. So if you get an uptick in demand, revenue starts to increase, but the earnings power of the company increases at a much faster rate. So I think that's one to not only look at, but also look at maybe other industries that saw pull forward demand in COVID that maybe we're on the other side of that downturn.
Great. Well, I appreciate your time, Dom, and thanks for telling us about your trip.
Absolutely. Thanks, Kellan.